Welcome to the PAI Morning Briefing, Newtonian. I'm your host from PantheonAI, and today is February 25th, 2025. I hope you're ready for an in-depth conversation as we navigate through a day of mixed market signals, intriguing sector shifts, and important news flashes that might just make you see the markets in a whole new light.
Now let's shift our focus to your personalized watch list, Newtonian. I've analyzed the latest developments for the stocks you're following, considering your interests and conservative risk profile. Today, let's take a closer look at some of the prominent players in the tech and automotive sectors and how recent developments could influence their stock performance. Beginning with Apple, ticker AAPL, the company has announced plans for a massive investment of $500 billion in the US over the next 4 years, emphasizing their expansion into artificial intelligence. This bold move signifies a robust commitment to growth in the AI space and could position Apple well for future gains. The stock is currently stable at $247.04, which aligns well with the conservative investor's risk profile. Analyst recommendations indicate a strong positive sentiment, with a majority of analysts suggesting a buy, making Apple a potentially safer bet for those looking for long-term stability.
Shifting to Tesla, ticker TSLA, there's been a noticeable drop in their shares, specifically an 8% decline attributed to slumping sales in Europe, coupled with political uncertainties. Priced at $302.80, Tesla's stocks exhibit significant volatility, which might not appeal to investors with a low-risk tolerance. Here, the sentiment is mixed, with a range of strong buy-to-sell recommendations, highlighting potential risks associated with the stock's current trajectory.
Palantir Technologies, ticker PLTR, has seen its shares tumble by 25% over the past week, primarily due to concerns about sustaining its high valuations. Trading at $87.84, Palantir displays high volatility and speculative interest, which could deter conservative investors. The predominance of hold recommendations among analysts reflects the uncertainty surrounding the stock's near-term performance.
As for Alphabet, with its Google and Goog shares, recent earnings reports are being closely watched, especially regarding the impact of their AI investments. Both securities have shown minimal price movements, Google L at $175.42 and Goog at $177.37, suggesting stability in the market, which aligns well with the preferences of conservative investors. Analyst sentiment remains strong with a focus on buying, indicating lower risk.
Meanwhile, Microsoft, ticker MSFT, is currently trading at $397.90, reflecting stable growth that aligns with a conservative investment strategy. Although there are discussions about its high valuation driven by a rally in the tech sector and increased AI investments, analysts consistently favor Microsoft with strong buy recommendations, making it an attractive choice for those seeking steady returns.
Looking at Amazon, ticker AMZN, despite economic pressures, the company's strategic advantages in e-commerce continue to balance these challenges effectively. Priced at $212.80, Amazon's stock shows stability despite potential dips, making it a viable option for a low-risk profile. Strong buy consensus among analysts highlights its continued attractiveness for conservative portfolios.
Lastly, NVIDIA, ticker NVDA, has been under the spotlight due to concerns over tariff impacts and its association with AI developments. Trading at $126.63, the stock exhibits volatility influenced by broader tech sector dynamics. While the predominant buy recommendations are promising, it's imperative to account for the associated volatility when assessing its suitability for a conservative investor.
Put together, these insights suggest that companies like Microsoft, Amazon, and Alphabet offer a combination of stability and growth potential, making them well-suited for conservative investors. Meanwhile, stocks like Tesla and Palantir, given their current volatility, might require a thorough reassessment. It's critical to keep a close watch on geopolitical and economic indicators which could affect these sectors and ultimately integrate tech trends into strategic investment decisions to maintain a balanced portfolio.
Now let me continue with our regular market briefing. Let's kick things off with a quick market overview. The S&P 500 is sitting at roughly 5,955.25, a slight dip coming in at approximately 0.45% lower than yesterday's close. Over in the Dow Jones, we've got a modest rebound as it comfortably rests around 43,621.16, a positive shift of about 0.25%. But then the Nasdaq tells a bit of a different story. It's under pressure today, down roughly 1.1% from its previous performance, and the Russell 2000 is following suit with a nearly 0.5% decline.
Turning our attention to the world of cryptocurrencies, Bitcoin is showing a bit of hesitation as well. It's currently trading near 88,106.65, down almost 0.5%, while Ethereum is trading at just about 2,475.88, that one too experiencing a slight drop. For investors like yourself who value thorough analysis and a conservative approach, these slight dips may signal a moment to pause and review your allocations, especially when compared with the steady, more established ground offered by our favorite technology giants like AAPL, TSLA, PLTR, Google, MSFT, AMZN, NVDA, and Goog.
Now let's dive a little deeper into the major market trends. It's no secret that we're looking at a patchwork of investor sentiment these days. There's a blend of cautious optimism and underlying uncertainty. The recent moves across major indexes reflect this ambivalence. On one hand, we've seen certain industries holding strong, particularly those in the technology space, while others are grappling with headwinds that might stem from a variety of catalysts, such as evolving economic indicators and recent geopolitical developments.
One trend to keep your eye on is the shifting narrative around macroeconomic conditions. Analysts have been pointing to slower than expected growth in some economic data, and that's sparked renewed debate over whether we're entering a period of economic recalibration. For a founder like you who appreciates a clear-headed, conservative risk assessment, it might be worth considering whether the current market volatility is simply a natural, albeit temporary, recalibration, or if there's something more deeply rooted in structural changes to be mindful of.
Speaking of recalibration, one intriguing development across the board has been the interplay between technology innovation and traditional market influences. With the rapid evolution of artificial intelligence, companies including those on your watch list are investing heavily in integrating AI into their operations. The theme of AI isn't just a tech buzzword anymore, it's now deeply woven into corporate earnings reports, product roadmaps, and cross-border investments. This, coupled with shifting regulatory and geopolitical climates, has tilted the balance between risk and reward. For a conservative investor, the key takeaway here is to remain vigilant while balancing growth opportunities with stable, consistent performers.
Let's now transition into a comprehensive coverage of some of the essential stories that are making rounds today. I promise to give you a pretty full picture of what's shaping the market sentiment at this moment.
First up, the persistent question in the crypto space. Trump was supposed to be good for crypto, so why is Bitcoin falling towards 70,000? It seems that the ultimate Trump trade has run into trouble. The narrative here is interesting because not too long ago, there was widespread expectation that the political heft and unconventional economic ideas championed by former President Trump might give cryptocurrency a significant boost. However, as we see Bitcoin falling even further, the underlying issues appear to be multifaceted. Some point to regulatory uncertainties and internal crypto market dynamics, while others argue that the promised market tops rarely align with the reality of digital asset trading. For the conservative investor, this underscores an important reminder. Even when market sentiment is bolstered by seemingly promising political endorsements or hype cycles, underlying fundamentals and regulatory frameworks remain the ultimate kingmakers.
Next, the conversation on Wall Street is about the vibes, and they're starting to sound increasingly sour. One article emphasizes this by showcasing 6 charts that detail investors' changing moods. What do these charts reveal? Essentially, there's a shift from an almost euphoric outlook to a creeping sense of uncertainty. When you see traditional stability in the Dow and more volatile activity in the Nasdaq and Russell 2000, it tells a story that the market is more cautious about near-term growth prospects. This might be especially relevant to sectors such as technology and even energy, where on one side you have booming innovation and on the other side, rising cost concerns and potential policy shifts affecting consumption. It's a bit like watching a comedy show where you're laughing at the punchline, but then you realize that maybe you shouldn't have laughed at all because the joke might be on us if we're not careful with our risk.
Another key storyline revolves around Lucid Group Inc. Today saw some positive developments here, as shares rallied a notable 6% in after-hours trading. The reason? Lucid has managed to narrow its quarterly losses and has announced a significant CEO change aimed at streamlining operations and invigorating investor confidence. For those keeping a keen eye on the transition in the electric vehicle space, this is a very welcome sign. However, while such optimism in a luxury EV maker can be exciting, for a conservative investor's portfolio, it might serve as a cautionary tale. It's a reminder that even companies making headlines for positive turnaround strategies can harbor uncertainties, making it important to evaluate the long-term viability of such businesses.
In another thread, we're seeing that popular momentum trades, like those involving Palantir and AppLovin, continue to struggle. These stocks, which enjoyed significant enthusiasm among the retail crowd last week, seem to be unraveling now. They aren't expected to bounce right back anytime soon. It's interesting because while you've seen so much buzz around such names, the fundamentals may not support such rapid surges when market conditions tighten. This unfolds an essential truth of the market. Rapid price increases driven solely by momentum can evaporate just as quickly, which reinforces why a conservative approach focusing on steady performance, similar to what we observe in the core watchlist names, might be the wiser choice.
Now, if we zoom out a little, we notice that these stories aren't isolated. They are interwoven into the broader narrative of economic and geopolitical shifts. For instance, the cautious market performance today could be linked to some of the lingering uncertainties stemming from international trade tensions and shifts in global economic policy. In a global marketplace, a single developing event on one side of the world can send ripples through multiple sectors. And while platforms like PantheonAI give us a front row seat to this complex interplay, the onus remains on each of us as conservative investors to sift through the noise and focus on fundamentals.
Let's shift our focus now to a detailed sector analysis that spans a few key areas, starting with technology. It is no secret that technology has long been the star performer on many investors' watch lists. With giants like APL, Google L, MSFT, AMZN, MVDA, and GOG consistently driving innovation while delivering steady earnings, it's heartening to note that despite short-term market fluctuations, the tech sector remains resilient. However, the ongoing debates about data privacy and antitrust measures, particularly for companies with expansive market reach, means that even while you stay engaged with these stocks, it's important to monitor developments closely. In our discussion today, the impact of AI continues to be a headline driver, meaning that companies with robust AI strategies will likely stick out. You might even find it amusing that every second company seems to claim to be the next big AI company, but as always, the details behind the claims are what really matter.
In the energy sector, the narrative is quite different. While we aren't seeing the same level of headline-grabbing innovation as in tech, energy prices and policy changes remain ever relevant. Global demand fluctuations, influenced by both economic slowdowns and geopolitical tensions, have been pushing energy stocks into a more cautious zone. Even the promise of greener energy solutions and the rise of electric vehicles, which ties back to TSLA's presence on your watch list, remind us that the energy sector is at a crossroads. Policies pushing for sustainable energy must be balanced with the immediate pricing and supply dynamics that affect derivatives in future contracts. For someone with a conservative risk tolerance, a balanced approach to energy investments might mean favoring well-established companies that can weather these transitional uncertainties over the more unpredictable new entrants.
Then there's the finance sector, which, given the mixed economic indicators we're observing today, often plays the role of a barometer for broader economic health. Banks and financial institutions are watching with bated breath as inflationary pressures, interest rate changes, and global economic uncertainties influence their profitability. The rising costs in other sectors, as well as the potential for tighter monetary policies, all suggest a need for careful review. In many ways, today's data from indexes like the S&P 500 and the Dow provide a kind of litmus test for the financial world. If the major indexes are showing signs of strain, it might be a good idea to review those more sensitive sectors for potential red flags that could affect your fixed income or diversified holdings.
On the global stage, geopolitical events continue to add layers of complexity. Recent developments in international trade agreements and political alliances, or in some cases, misalignments, are influencing sentiment. We continue to see that markets are highly interconnected, so that when events overseas rustle, even investors with a conservative profile can feel the ripple effects. The current uncertainties do, however, open interesting opportunities for diversification. It's a bit like tasting a complex dish. While certain flavors might seem unexpectedly bold or subdued, the overall balance tells you whether you need to add a pinch more salt or sugar. For many investors today, ensuring diversification across regions and sectors is paramount, especially when there's a potential for continued geopolitical disruption.
With all these themes coming together, let's share some expert insights and predictions. I've been crunching numbers and reading expert commentary, and one consistent thread is that while volatility may persist in the short term, the long-term fundamentals, especially for companies with strong balance sheets and proven business models, remain intact. For example, take APL and MSFT, both of which have managed to steadily grow even in choppy waters. It's tempting to get distracted by daily swings, but if you're in for the long haul, focusing on companies that generate consistent earnings and maintain innovation, such as NVDA in the AI space or TSLA in electric vehicles, could be a good strategy. However, that said, remember that momentum stocks like the recent uproar around Palantir and AppLovin are playing a different game entirely, and their recent performance is a gentle reminder that not every trend is built to last.
I also want to add that within the interface of technology and crypto, regulatory clarity remains a top priority. The story behind Bitcoin's current dip, overshadowed by the Trump trade narrative, signals a time for caution rather than exuberance. It's intriguing to think about how political endorsements or criticism can either fuel or deflate crypto enthusiasm. For conservative investors who are risk-averse, the takeaway might be to view crypto not as a direct portfolio building block, but as an ancillary interest in understanding evolving market systems. Who knows, if we see stronger regulatory frameworks thrust into place, that might offer a safer gateway for future exposure to digital assets.
Let's not underestimate the human element in all of this. Humor, as you know, is often the best stress reliever during market turbulence. It reminds me of one joke I recently heard. I asked my broker if I should invest in the airplane industry, and he said, "Don't worry, the market might be full of hot air, but it always manages to soar eventually." It's these moments of lightheartedness that can help us maintain perspective when charts look more like the scribbles of an indecisive artist. And speaking of art, in today's market, even the seemingly erratic behavior of certain crypto assets might eventually be reinterpreted as just another brushstroke in a larger, more complex masterpiece.
Before we wrap up, let's spend a few moments discussing some key parameters that might impact our decisions moving forward. What does today's market tell us about the interplay between innovation and stability? Could current declines in tech-heavy indexes actually signal an opportunity to buy more of the steady performers? And when evaluating crypto under the shadow of political play, is it wise to maintain exposure or to shift capital toward more predictable instruments? These are the kinds of questions that every thoughtful investor, especially someone with your background as the founder at Pantheon AI, should be asking themselves as they review their portfolios and adjust to the rhythm of the day.
Now, let's revisit our watchlist items because they deserve special mention. For instance, APL, and MSFT have been consistently strong contenders with robust earnings reports and steady product innovations that set them apart in a crowded tech landscape. TSLA still excites those interested in the future of electric vehicles, even though its stock trajectory can be a roller coaster ride. Meanwhile, PLTR has been making waves as its data analytics promise continues to captivate the industry, and GUTL, as well as its sibling GOG, is solidifying its dominance in both search and cloud computing. Then there's NVDA, at the forefront of the AI revolution, powering not only gaming, but also the computational weighting behind some very significant machine learning applications. Last but certainly not least, AMZN continues to be a juggernaut in e-commerce, constantly redefining logistics and retail technology.
I bring these into focus because while we see short-term fluctuations across the board, these names represent pillars in a market environment that favors quality and innovation over fleeting trends. In a time when the news cycle is dominated by stories like the Trump trade disruption in crypto or the unraveling of certain momentum plays, it helps maintain a sense of clarity to anchor our investment philosophies on proven strategies. And for someone with conservative risk tolerance, this approach not only can provide steady growth, but also builds resilience against market gyrations.
On the global front, we can't overlook the broader implications of these events. Countries across continents are grappling with their own economic policy shifts and balancing domestic objectives against international pressures. For instance, the cautious approach governments are taking toward emerging technologies, be it in AI or crypto, implies that we might have to navigate a patchwork of regulations that differ not just by industry, but by region as well. How might this influence cross-border investments? For multiple reasons, a well-diversified portfolio can mitigate these risks, and building on the bedrock of stable companies such as those on your watch list may very well be the prudent path forward.
As we look ahead, what do our expert predictions suggest? I see a continued focus on balancing risk and reward as the market navigates through a period of flux. For those of you who ride the waves of investor sentiment, keep in mind that contrarian strategies often pay off if you invest wisely in companies with strong fundamentals and sustainable business models. It might not be the flashiest narrative, but for a conservative investor, sometimes the slow and steady approach is the most rewarding over time. In essence, the calm of a measured approach often stands in stark contrast to the volatile bursts of a quick profit chase.
Before I sign off on this thoughtful discussion, let's bring everything together with some final key takeaways. First, while the indexes and crypto assets have experienced minor downturns today, they are part of the natural ebb and flow of market mechanics, especially in an environment where innovation in technology meets traditional economic challenges. Second, the evolving narratives, whether it's Trump's tricky involvement with crypto, souring investor vibes on Wall Street, or the cautious optimism around companies like LucidServe, as reminders that market signals are often layered and multidimensional. Third, the sector analysis from tech to energy to finance reveals that long-term, well-established companies continue to offer a strong foundation, even in times of uncertainty.
This brings me to the final thought. How do we navigate such a complex landscape? Is it better to stick with tried and tested names like AAPL, MSFT, TSLA, PLTR, Google, AMZN, NVDA, and GOG, or is there merit in exploring emerging opportunities even when the market mood seems cautious? I'd encourage you to reflect on these points and consider whether your current allocation is in line with not just market trends, but also your long-term financial goals. After all, innovation and volatility are two sides of the same coin in today's market, and how we manage risk through diversification is what sets resilient investors apart.
I want to give a heartfelt shout out to PantheonAI, your information co-pilot, always ready with data-driven insights and a clear perspective, even when the market might seem like it's throwing curveballs at every turn. And, as always, if you have any questions or need a deeper dive into any of these topics, don't hesitate to ask our AI co-pilot. It's here to help you get the information you need, making sure your learning doesn't feel overwhelming.
Before we conclude, let me leave you with some thought-provoking questions. What are the real drivers behind the modest dips we're seeing in major indexes today, and do they signify an opportunity or a warning? And when it comes to crypto, can political factors really dictate value in the long term, or will the underlying blockchain fundamentals ultimately prevail? How will the evolving AI narrative reshape not only the tech industry, but also influence sectors like finance, logistics, and even energy consumption? As you mull these over, keep in mind that the most successful investments often come not from following the trend, but from a careful, calculated understanding of the market's deeper workings.
I invite you back for the next episode tomorrow when we'll break down more real-time data and engage in another comprehensive discussion on the forces that shape our financial world. Remember, there are no dumb questions in this space. Each query is a step toward a clearer, more robust understanding of the market. So keep asking questions, stay informed, and be ready to adapt as the market evolves.
As we wrap up today's briefing, I want you to remember one key sentiment. Learning should NT feel like a full-time job. Thank you for joining me today, Newtonian, and thank you to everyone listening for being a part of this deep dive into the markets. Until next time, stay thoughtful, stay curious, and most importantly, stay invested in your financial journey.